Your broker just sent you a notification. Your portfolio hit a new high, $2.3 million. You're sitting there looking at that number and you feel rich. You feel like you made it, like all those years of boring investing finally paid off. You feel like a genius. But here's what your broker isn't telling you, and this is the part that matters. You're actually poorer than you were 5 years ago. Not metaphorically, mathematically. I'm not being dramatic. The purchasing power of your $2.3 million is less than what you would have had if you just kept your $100,000 and bought one specific thing. And that person who played it safe with cash, the person everyone told was being stupid by not investing, he lost even more. He's down to $73,000 of actual buying power. But there's a third guy, a completely different story, and he got genuinely rich, really rich. And he didn't do any of this. Let me break this down because it matters. 3 guys all started with 100 grand in 2020. First guy, he listens to the standard advice. Max out your retirement account, diversify into stocks and bonds, ride the S&P up for 5 years. By 2025, his brokerage app shows 2.3 million. That's a 23 times return. Incredible, right? Second guy is conservative. He's nervous about the market, so he puts money in a savings account, maybe some bonds, things that are supposed to be safe. In 2025, he's got $73,000 of actual purchasing power. A third guy, he doesn't follow either of those paths. He takes his 100 grand and he buys land. 2 hectares outside a small town on the border between 2 states. Nothing special, just dirt and grass. He doesn't get fancy notifications on his phone about his investment going up. He just owns land. By 2025, that land is worth $425,000. That's a real $425,000. He got richer, actually richer. Everyone else got trapped. Now, before I go any further, let me tell you what you're going to get out of this. By the end of this video, you're going to know exactly which 3 categories of assets are about to make regular people actually wealthy, instead of just feeling wealthy. You'll know what the world's richest people and the institutions that control the global financial system are already buying right now. And most importantly, you'll know exactly what you need to do with your money this week to not get destroyed by what's coming, because something is coming and the window to position yourself is closing. Here's the thing that mainstream financial channels won't tell you because they're paid not to. They keep pushing diversification and long-term investing and bonds as a safe haven. They tell you this over and over because their sponsors are the banks and the brokerage firms. The entire system makes money when your money stays trapped inside their system. Every dollar you have moving around in their ecosystem is a dollar they're taking a commission from. Every single month you pay fees, every trade you make they're taking a cut. The longer you believe that stocks are the answer, the longer you believe that bonds are safe, the longer you stay captured in this system paying them. It's a fundamental conflict of interest. They profit from you not understanding what's actually happening. So let's look at what's actually happening, the real mechanics behind this. What's really going on while everyone's staring at their brokerage apps? 2020 hits, the pandemic starts, governments panic, central banks around the world hit the accelerator on the money printing machine. First wave of stimulus, then second, then third. Over 2 years, roughly $4 trillion gets pumped into just the United States economy. 4 trillion. Stop for a second and think about that number. That's more than the entire annual GDP of most countries on the planet. 4 trillion in stimulus checks, in business grants, in zero interest loans, in buyback programs, trillions. Where did all this money actually go? You think it went to Main Street? People buying groceries and paying their landlords? Sure, some of it did, but where did the bulk go? It went straight into stock market speculation. People were sitting at home, got these government checks, opened up their brokerage apps on their phones and started trading stocks. All that freshly printed money flooded into the market. The result? The S&P went up about 100% in 2 years. You ever seen growth like that? Not in any company's earnings, not in productivity, not in any real economic metrics, just pure liquidity. Money printing creating the illusion of growth. But here's what happened at the exact same time. Food prices exploded up 25%. Housing prices jumped 30%. Energy costs spiked 40%. This isn't theory. This isn't something I'm speculating about. This is Bureau of Labor Statistics data, official numbers. You can verify this yourself right now. So what actually happened? You had people in the stock market. They look at their portfolio in 2025 and they see 2.3 million. They're thinking they're geniuses. They're thinking the system rewarded them. But $100,000 worth of actual stuff before this period, the same stuff now costs $200,000 to buy. Your stocks went up, but the world got more expensive at almost the same rate. You didn't really win. You were running on a treadmill thinking you were climbing a mountain. Meanwhile, the person who was being conservative with cash, they got absolutely crushed. They've got $73,000 and everything costs double. They're actually poorer. They lost badly, but they didn't understand why. They didn't know they were being sacrificed to prop up the stock market. The system was literally transferring their wealth to the first guy, and that first guy didn't even realize it. He thought he was smart, he thought he made it. The third guy with the land is looking at this completely differently. His land went up 325%, not because land got better, but because the money supply expanded and real assets hold value when currency gets destroyed. He made real money, actually real, and he understands exactly what happened. Here's where it gets important. The people at the top understand this game. The people running the central banks, the politicians with access to real information before it hits public channels. The institutions managing trillions of dollars, they see what's happening. They understand the mechanics. So in August of 2024, something extraordinary happens. Central banks around the world start buying gold. Not a little, massive amounts, record amounts, 600 tons in a single day. Think about that, 600 tons. That's equivalent to the weight of 20 heavy trucks, all in one day. That's a record going back decades. Now ask yourself a logical question. If you're running a central bank and you believe your system is stable, your currency is strong, everything is under control, do you panic by gold like that? Of course you don't. You don't do anything. You keep managing things normally. You don't make unusual moves, but when you're seeing the cracks in the system, when you know something's coming, when you can do the math and realize the debt can't be repaid and the currency is going to lose value, what do? You buy the thing that can't be printed. You buy the thing that has held value for 5,000 years. Gold. That one day of central bank gold buying wasn't strategy. It was panic. It was the people running the system preparing for the system to fail. And right now, trillions of dollars are moving. Sovereign wealth funds are repositioning. The portfolios of the world's richest families are shifting. Institutional money is in motion. Bill Gates isn't buying farmland because he wants to be a farmer and grow corn. He's buying farmland because he understands that land is the new currency. Pension funds aren't investing heavily in infrastructure because they love bridges and roads. They're doing it because infrastructure is control of flows, and control of flows is control of leverage in the new economy. Corporations aren't quietly accumulating critical raw materials because they need them for production next quarter. They're accumulating them because whoever controls the metals, the minerals, the resources in the next world controls everything. If you followed the standard investment advice back in 2020, your portfolio is probably positioned about 70% in stocks and bonds. Over 5 years, your stocks grew. Fine, good for you. But gold went up 200%, land went up 300%, mining and commodity companies went up 350%. If you'd been positioned in these real assets instead of traditional stocks and bonds, your returns would have been at minimum double or triple what you actually got. And critically, you would have protection against what's starting to happen right now in the economy. What's starting to happen, phase 2 of this cycle is beginning. The printing stops, the central banks can't keep doing this indefinitely. Interest rates have to go up because if they don't, the dollar becomes toilet paper. That's not speculation. Look at historical precedent. Weimar Germany, Zimbabwe, Venezuela. These weren't chaotic countries with no education. These were functioning economies where people had jobs and education and infrastructure. But the currency got destroyed. The money printing went too far. And in a matter of months, the currency became worthless. Let me give you a specific example because this matters. A teacher in Venezuela in 2012 made a solid 6-figure income. Not wealthy exactly, but comfortable. You could live well in Caracas on that money. Send your kids to private school, have a nice apartment, travel. By 2023, that same person's monthly pension, which was supposed to be secure, couldn't buy groceries for a month. The money didn't disappear. The number was still there, but the value was destroyed from the inside, diluted. And you think that can't happen to you? You think America's different? The only difference is timeline. The mechanics are identical. When this printing stops, when the Fed has to finally put the brakes on the money machine, stock markets are going to fall. Not because companies got worse, but because stocks went up because there was more money chasing them, not because the businesses actually became more valuable. It was all monetary expansion. Now that's reversing. The stocks lose their support system. People who thought they had millions watch it vanish. Could take days, could take weeks, but it's coming. Bonds become toxic. There's $300 trillion in debt globally. That's the amount owed by governments, by corporations, by individuals. Nobody's paying that back. Not America, not Europe, not China. Mathematically impossible. The system doesn't work. But instead of talking about this reality, instead of having an honest conversation about it, you get nice speeches about recovery and sustainable growth and green transitions. The reality underneath is that this system has to reset. And when it does, the only things that'll have actual value are the things you can touch and hold and use. Land, gold, infrastructure, commodities, everything else could go to zero. Now let me tell you why this is happening right now. Why 2025 to 2030 is the critical window. Why this specific 5-year period matters more than any other 5-year period in your lifetime. The entire modern financial system is built on a foundation that doesn't work anymore. Every year the economy needs to grow. 3% minimum. 4% is good. Anything less and people call it a recession and panic sells everything. So what happens when growth stops? The central banks do what they've always done. They print money. It's like an addict needing a fix. The first time you print 5% of GDP in stimulus, it works. The economy gets a boost. You feel like you fixed it. But your body builds tolerance. Next crisis needs 10%, then 20, then 30. By 2020, the system was printing 100% of GDP in new money in a single year. 100%. 1 year they printed as much value as their entire economy created. That's not sustainable. That's not even close to sustainable. That's the kind of math that breaks systems. And here's the problem. This is happening everywhere. America, Europe, Japan. The developed world decided about 30 years ago that they could borrow forever and print forever and it would never catch up with them. Japan tried this in the 90s. They printed money constantly to try to stimulate a dying economy. 30 years later, they're still stuck. Growth never came back. The printing just inflated asset prices. Real productivity died. That's the future for the US and Europe if this keeps going. Slow death disguised as policy. On top of that, you've got demographics working against you. The entire developed world is aging. America's America's median age is 38, Europe is even older, Japan is ancient. This means fewer young people creating wealth, fewer workers supporting retirees, fewer consumers. If you've got fewer consumers and you need infinite growth, the only way to fake it is printing money. But printing money into a shrinking consumer base just creates inflation. Prices go up, real wages go down, people get poorer, they consume less, growth slows more. It's a death spiral. Then you add geopolitics into this mess. The world is breaking apart. BRICS nations are starting to abandon the dollar for trade. China and India together make up nearly 40% of global GDP, and they're actively moving away from using American currency for settlements. What happens when the dollar stops being what everyone wants? It collapses. That's not theory. That's what happened to every reserve currency eventually. The British pound lost its status, the Dutch guilder, the Spanish real. They're all footnotes in history. The dollar's turn is coming. When it does, people who held dollars are going to get decimated. And here's what you need to understand about what comes next. When this system resets, when the dollar loses reserve status, when central banks can't print their way out anymore, wealth is going to do something it always does. It's going to move. Money is going to flow out of things that can be printed, things that can be created infinitely, things that are just digital numbers on a screen. It's going to flow into the only things that actually matter. Things that are scarce, things that you can touch, things that produce actual value. This is where the three categories come in. The three assets that are about to make some people wealthy and destroy everyone else. The first one is land. Not real estate in the traditional sense, not investing in residential real estate where you're betting on neighborhood gentrification or population growth. I'm talking about productive land, agricultural land, prime farmland, land that produces food. This is going to be the most valuable asset class over the next 5 to 10 years, and here's why. The global population is heading toward 10 billion people, 10 billion mouths to feed. Meanwhile, global crop yields are actually declining. Climate volatility is increasing. Weather patterns are getting less predictable. Droughts in one region mean supply shocks globally. Heat waves destroy harvests. Every year, the margin between global food production and global food demand gets narrower. Within 5 years, you're going to see genuine food shortages in some parts of the world. Not famine exactly, but actual rationing and real price spikes. The countries and the people who control land that produces food are going to have leverage over everyone else. That's how leverage works in a crisis. Control over basic needs equals control over everything. Let me give you a concrete example. In Brazil, they started tracking farmland prices in 1980. Over the past 40 years, Brazilian agricultural land has gone up about 10% per year on average. That's compounding. Do the math. Investment that would have cost you $20,000 in 1980 is worth about 1.2 million today. 1.2 million. That's from just buying farmland and holding it. The food never stopped being needed. The land never stopped producing. That's just math, but the real play isn't buying a small plot for yourself and farming it. The real wealth is going to be made through aggregating land and building productive capacity. There are funds now that buy agricultural land specifically in regions where climate patterns are improving. Southern Canada, northern US, parts of Russia, parts of Australia where water is becoming available. These funds are consolidating land before the general public realizes what's happening. By the time regular people figure it out, prices are already triple what they are right now. The window for getting into this at reasonable prices is closing. The second category is precious metals, primarily gold but also silver and the rare earth elements. Gold is going to be important for a specific reason. It's the ultimate insurance policy against currency collapse. Every major fiat currency in history has eventually failed. All of them. And in every single case, the people who owned gold survived financially intact. That's not luck, that's pattern. Gold has held its purchasing power for thousands of years. You can't print it, you can't create it out of nothing, you can't debase it. Central banks know this, which is why they're hoarding it. If gold was just a relic that didn't matter, why are central banks worldwide accelerating their gold purchases? Because they know what's coming. The numbers are wild if you look at them. China has been buying gold steadily for years. Their stated gold reserves have more than tripled since 2000. Russia was buying gold constantly right up until sanctions. India is buying gold. Every smart central bank is hoarding it. Why? Because they understand that when the current monetary system collapses, the next system will need gold backing, or at least gold as a component. The countries that have the most gold will have leverage in negotiating what the new system looks like. The countries without gold will be at the mercy of everyone else. For individual investors, this is simpler. Physical gold holds value when currencies debase. That's it. That's the play. Not gold stocks, not gold futures, physical gold, coins you can hold, small bars you can store. When things get chaotic, gold doesn't have counterparty risk. You hold it. Nobody can freeze it. Nobody can devalue it. It's yours. That matters when everything else becomes questionable. But here's where it gets interesting. Gold alone isn't the complete story. Because the real wealth in a resource-constrained world goes to whoever controls the raw materials that actually run things. And those raw materials are the rare earth elements. Lithium, cobalt, nickel, copper. The entire global economy's pivot to electric vehicles and renewable energy is completely dependent on these materials. Every electric car battery needs massive amounts of lithium and cobalt. Every solar panel needs specific rare earths. Every wind turbine needs rare earth magnets. Without these materials, the green energy transition stops. It doesn't continue. It just stops dead. And here's the problem. One country controls about 80% of rare earth element processing processing. China, 80%. You think China is going to allow that supply to be disrupted? You think they won't use it as leverage? This is already happening actually. China's been restricting rare earth exports in various ways, not a total ban, just enough to remind the world that they've got leverage. As global competition for these materials increases, China's leverage increases. The price of rare earths goes up and up. Companies that mine these materials see their stocks explode in value. That's not speculation. That's basic scarcity economics. The third category is infrastructure, but not the kind you might think. Not buying stocks in infrastructure companies necessarily. I mean controlling actual physical infrastructure, water systems, power generation, ports, transportation networks. In a resource-constrained world, infrastructure is everything. You want to move commodities from point A to point B. You need the infrastructure to do it. You want to process raw materials. You need the power and the facilities. Control infrastructure and you control flows. Control flows and you control pricing and leverage. This is why sovereign wealth funds are quietly buying up ports in various countries. It's why pension funds are investing heavily in electrical grid infrastructure. It's why there's been so much consolidation in water treatment companies. These entities understand that in the next 50 years, infrastructure access is going to be more valuable than it is today. The funds that are positioned in this space 5 years early are going to make multiples on their investment. The funds that wait until everyone figures it out will get pennies on the dollar compared to early movers. Let me give you a real example. Take Singapore. Singapore has no natural resources, no oil, no gas, minimal agricultural land. But Singapore became wealthy by controlling infrastructure, ports, shipping routes, refining facilities. By controlling the infrastructure through which trade flows, Singapore extracted enormous value. That model is about to become the dominant model globally. Whoever controls the infrastructure through which resources flow will have outsized leverage. That's not theory. That's just how power works when resources become scarce. So you've got three categories: land that produces food, precious metals that hold value when currencies collapse, and infrastructure that controls flows and resources. These are going to be where wealth concentrates over the next 5 years. Not in stocks that depend on corporate earnings continuing at historical rates. Not in bonds that depend on governments paying back debt they can't afford. In real, physical, productive assets. Now here's where the urgency comes in. This isn't some vague future scenario. This is happening right now. Central banks are actively shifting their balance sheets into gold and real assets. Billionaires are consolidating farmland at an accelerating pace. Sovereign wealth funds are competing with each other to buy infrastructure assets. The smart money made its move years ago. What's left is opportunity for people who move now. But the window is closing. As more money figures out where it needs to go, prices rise. When prices rise early, movers profit. Late movers get whatever's left at inflated prices. Think about the timeline. We're in 2025. The next 5 years are probably the last moment where you can get into these assets at rational prices. Once we hit 2030, assuming the crisis is either fully apparent or has already partially happened, the prices for real assets are going to be completely different. Much higher. You'll be paying 5 to 10 times more for the same piece of land, the same bar of gold, the same piece of infrastructure. The opportunity cost of waiting is enormous. The opportunity cost of staying in paper assets while this transition happens is going to be catastrophic for most people. Here's what the statistics show you if you're paying attention. Over the past year, institutional investors moved approximately $400 billion into real assets and out of traditional financial assets. $400 billion. That's not guessing. That's data from major investment tracking firms. Those money managers know something. They're not moving capital for no reason. They're moving it because they see what's coming. They're positioning before the panic. And that's when the panic comes, when regular people finally figure it out, when they see their portfolio down 50% and they realize it's not coming back. That's when they all try to move into real assets at the same time. That's when prices spike. That's when you're buying at the top instead of riding the wave up. The difference between someone who moved now and someone who waits is probably going to be generational wealth. I'm not exaggerating. The person who converts $50,000 into land and precious metals right now could easily see that become $300,000 or more by 2035 as the crisis unfolds and real assets become the only things that hold value. The person who stays in the system and waits until it's obvious will watch their wealth decline and they'll be late to the party trying to buy at inflated prices. But here's what I want you to understand. It's not too late. The transition is happening, but it's not complete. Prices for real assets are still rational. You can still buy farmland at reasonable valuations. You can still buy gold without crazy premiums. You can still find infrastructure investment opportunities that haven't been completely picked over by institutional money. The opportunity is there, but it won't be there in 2 years, 3 years maximum. After that, you'll be too late. Now let's get practical, because knowing what's coming doesn't help you if you don't know what to actually do about it. The information is worthless if you can't act on it. So let's break down how different people with different amounts of money can actually position themselves. And let's be honest about the real constraints people face. If you've got a small amount of money, let's say between $1,000 and $5,000, your job is simple. You need to own physical gold and silver. Not a lot, just enough that you have some real money insurance. Here's how this works. You go to a local coin dealer or a reputable online dealer and you buy physical gold coins. 1-ounce coins are standard. American Eagles, Canadian Maple Leafs, Austrian Philharmonics, these are government minted coins, so they're standardized and universally recognized recognize. They cost a little more than spot price because there's a premium for the coins themselves. That's normal. That premium usually runs 5 to 10% over the raw gold price depending on market conditions. Why coins and not bars? Because coins are easier to trade. If things get weird, if you need to convert gold to cash or to other goods, coins are recognizable everywhere. Someone sees an American Eagle coin, they know exactly what it is and what it's worth. A bar from some random refinery might be harder to move. Coins are liquid, that matters. The amounts are small on purpose. If you have $5,000, you're buying 5 1-ounce coins roughly. That's insurance. That's your hedge. You're not betting the farm. You're protecting yourself because if the currency does collapse or if there's significant inflation, that physical gold is going to hold value while your cash holdings disappear. It's just sensible risk management. If you've got a medium amount of money, somewhere between $5,000 and $50,000, now you can actually start building a real portfolio. And this is where you need to diversify. You're going to take that money and split it 3 ways roughly, maybe 30% into physical precious metals, gold and some silver. Silver is cheaper, so it gives you more ounces for the money, which has some advantages psychologically, and for smaller transactions if needed. 40% into agricultural land or agricultural land funds. There are actual funds now that specialize in buying farmland, particularly in regions where climate change is actually improving agricultural conditions. Northern US, southern Canada, certain parts of Australia and New Zealand. These funds handle all the complexity. You just invest capital and they manage the land. 40% can go into commodity stocks and mining companies. Companies that are extracting lithium, cobalt, rare earths, copper, actual mining operations. The reason you do stocks here instead of physical commodities is because you can't practically store large amounts of lithium or cobalt, so you own the companies that control the supply. As prices rise, these companies see massive profit expansion. Their stock prices explode. You get leverage on the underlying commodity prices. $50,000 split this way means $15,000 in metals, $20,000 in agricultural land funds, $20,000 in mining and commodity stocks. That's a real diversified position. That's not gambling. That's strategic positioning across 3 asset classes that are all about to benefit from what's coming. If you've got a larger amount of money, let's say $50,000 to $200,000, you can start buying actual physical land, not through a fund, actual property. This is where it gets really interesting because real estate in most developed countries is actually pretty liquid. You can buy 5 to 10 acres of productive farmland in most states for $30,000 to $50,000. Maybe more in some regions, less in others, but that's a reasonable range. You do this and you own something real. You can drive out and look at it. You own the deed. Government can't print more land, they can devalue the currency, but they can't create more land. The advantage of owning actual land versus going through a fund is that you get full control and you avoid fees. Funds charge management fees usually in the 1 to 2% range annually. Over 10 years that compounds. If you're comfortable doing the due diligence yourself, buying actual land is probably better economics for larger accounts. You'd split $100,000 roughly this way. Maybe $25,000 in physical metals, another $25,000 in maybe 1 or 2 actual land purchases. That leaves $50,000, which goes into a combination of mining stocks, commodity ETFs, and maybe some allocation to infrastructure companies. Infrastructure is trickier for regular individuals because the good infrastructure plays are usually accessed through pension funds or sovereign wealth funds. But there are infrastructure-focused investment trusts that you can buy that give you exposure. They're traded like stocks. REITs is what they're called, real estate investment trusts. Some of those focus specifically on infrastructure. For people with very large amounts of money, over $200,000, you can access private infrastructure deals. You can buy actual land in larger quantities. You can potentially do private placement deals in mining or energy infrastructure. You probably need to work with an advisor at this level because the deals are complex, but the access is there. Here's what matters though, regardless of how much money you have. The first step is deciding to move. That's the hardest part because doing nothing feels safer than doing something. It feels like if you do nothing, you can't lose. Of course, that's totally backwards. If you do nothing, you are guaranteed to lose. You're guaranteed that your wealth in cash and paper assets will decline. You're guaranteed that while you wait, prices for real assets will rise. The people who don't move are the ones who actually get destroyed. Now let's talk about what can go wrong, because obviously there are risks. If you're buying land, there's the risk that you're buying in the wrong region. Climate patterns are complex. What seems like an improvement could shift. You could overpay for land, you could get involved with local corruption or title disputes in some countries. These things happen. That's why for most people going through funds is actually smarter. The professionals do the due diligence. They deal with title issues. They have scale, which means lower costs. It's not as romantic as owning your own land, but it's more practical. If you're buying metals, there's the storage risk. If you keep physical gold at home, you're relying on your own security. Safes can be broken into, houses can be robbed, fires happen. Some people use safe deposit boxes at banks, which is slightly safer, but banks could potentially restrict access during a crisis, which defeats the purpose. Some people use private vault services, which are more expensive, but probably the most secure. You have to decide what level of security you need based on your situation. The other risk is overpaying. When you buy physical metals, there's a premium over spot price. If you buy at the wrong time when premiums are high and then prices correct, you can take a loss. This is minor though, because over a long time frame, 5 to 10 years, spot prices should rise enough to overcome any reasonable premium you paid. If you're buying mining stocks, the risk is obvious. Mining companies can go out of business, they can have operational problems, ore grades can be lower than expected, costs can spike. A mining company that looked great can turn out to be a bad investment. You mitigate this by diversifying. You don't put all your mining allocation into one stock. You buy multiple mining companies. Better yet, you buy a mining ETF or a mining-focused fund. They hold dozens of companies. If a couple go bad, the fund still performs because the winners outweigh the losers. The bigger risk, though, is the psychological one. Most people who move money into these assets are going to experience volatility. Gold can drop 20% in a month. Mining stocks can be incredibly volatile. Land prices might go down temporarily. Most people then panic and sell. They bail out right before the recovery. That's the killer. It's not the investments that fail, it's the investor's psychology that fails. You have to go in with the understanding that there will be periods of loss. There will be times when you question whether you made the right decision. If you can't handle that, if you're going to bail out when things look bad, then don't do this, because bailing out during downturns is how you guarantee losses. Here's what I tell you about timing and psychology. Don't try to catch the exact bottom. That's impossible. You'll never know when the bottom is until months or years later. What you do is dollar cost average into your positions. If you got $50,000 to deploy into real assets, don't do it all at once. Do it over 2 to 3 months. 10,000 this week, 10,000 next week, that approach. This way you're not trying to time the market, you're putting money in regularly, and if prices drop while you're deploying capital, you're actually buying more for your money, which is what you want. Real people are actually doing this right now. I know a fund manager in Toronto who started noticing 2 years ago that his clients were increasingly asking about real asset exposure. He was the guy recommending balanced portfolios with lots of stocks and bonds. 6 months ago, he restructured his entire approach. 40% of client money is now in agriculture, precious metals, and mining. He says it's the most conviction he's had in any portfolio positioning in his entire 20-year career. His clients are up substantially while the broad market is flat, because real assets have been leading for the past 18 months. I know an individual investor in New Zealand who 3 years ago had most of his wealth in a standard index fund portfolio. Index funds full of stocks. He read about central bank gold buying. He started digging. He spent 6 months really understanding what was coming. He moved 50% of his portfolio into precious metals and farmland investments. His friends thought he was crazy. Those same friends are now down on their portfolios while he's up. Not dramatically up, but up while everything else is down. He's ahead in a period when most people are falling behind. There's a woman in Calgary who started buying agricultural land 5 years ago. Not a huge amount, just small amounts each year. She bought 2 farms. Nothing fancy, just productive land. Those farms have appreciated maybe 30%. That's not dramatic. But more importantly, the farms produce revenue. They generate cash flow. She rents them out to farming operations. She gets income that actually exceeds inflation. So her wealth is growing and she's generating income, and she's got real assets that can't be devalued by a central bank. That's the position you want. You want income producing real assets. The key insight is that most people are doing nothing. They're staying in their comfortable, familiar positions. Stocks, bonds, maybe some real estate, residential property, and they're going to be destroyed by what's coming. Not because they're stupid, just because they didn't move. They didn't act. They assumed the system would continue working the way it always has. But systems don't work that way. Systems reach their limits. And when they do, the people who prepared are the ones who survive intact. The people who didn't prepare, they're the ones who pay the price. Here's the thing about what's coming that you need to really internalize. This isn't a single event that happens on a specific date. It's not like a nuclear bomb goes off and suddenly everything changes. It's a process. It's already happening. The dollar is already losing status. Central banks are already moving into real assets. The wealth transfer is already occurring. It's just happening slowly enough that most people don't notice it. By the time it becomes obvious to everyone, by the time it's headline news everywhere, the opportunity window has already closed. That's why people who moved 5 years ago are already way ahead. They got in when no one was paying attention, when assets were still priced reasonably. Now they're positioned beautifully. The people who move now, they're still early, but they're later than the early people. They'll still do well because the trend still has 5 to 10 years to play out, but they won't do as well as the 5-year early movers. And the people who wait another 2 years, they're going to buy at prices that are going to seem insane. They're going to regret not moving earlier. That's how these cycles work. The people who understand what's coming move when it's not obvious. The people who wait until it's obvious, they buy at the top. So let me ask you something. Where are you in this timeline? Are you one of the people still holding paper, still trusting the system, still hoping it works out, or are you ready to move? Because the difference between those two positions is going to be significant, really significant. The kind of significant that determines whether you're comfortable in retirement or you're stressed about money. The kind of significant that determines whether you're building wealth or you're just trying to preserve what you have. The first step is actually the simplest. You just have to decide that you're gonna do something. You don't have to do everything at once. You don't have to have all the answers. You just have to decide that staying in the current system isn't your best move. That's it. That's the first step. Because once you make that decision, the research comes naturally. You start learning about farmland funds, you start understanding where to buy gold, you start looking at mining companies, you start connecting the dots, and within a couple weeks you can have a plan, within a month you can be executing, within 6 months you can be positioned in a way that's completely different from 90% of people, and then you get to watch what happens next, knowing you made the right move. I'm going to end with the same question I started with. Remember those 3 guys? One guy with his brokerage app showing 2.3 million, one guy with his cash savings depleted, one guy with his land appreciating steadily. Where do you want to be? Because that's the choice you're making right now. You're not making it consciously maybe, but you're making it. Every day you stay in cash or paper assets, you're choosing to be guy number 2, the person who's losing slowly without realizing it. Every day you avoid moving into real assets, you're making that choice. But if you move now, if you actually do the work and position yourself correctly, you can be guy number 3, the guy who understands the system and positioned himself outside of it, the guy who's going to watch everyone else panic while he's calm, knowing he prepared. The opportunity is there, the window is still open, the prices are still reasonable. Everything you need to know, you already know now. You've watched this entire video, you understand what's happening, you understand why it's happening, you understand how to position. The only question left is whether you're going to act on it or whether you're going to let this moment pass. And trust me, you don't want to be the person in 5 years looking back thinking I should have done this when I had the chance, because that's a feeling you don't come back from. That's a regret that stays with you. The smartest investors in the world are already positioned, the central banks are already buying, the wealth is already flowing. The question is whether you're going to be part of that flow or whether you're going to be left behind. The window won't stay open forever. Your next move determines your next 5 years. Make it count.